with that, my friends, the final trading session of the week is underway. Joining me now, Eddie Ghabour, managing partner at Key Advisors Wealth Management. Eddie, it is always great to talk to you. Okay, so let me get your perspective first and foremost with what we're seeing with the markets right now. Obviously, I think we had a sense we'd be off and running in positive territory, Eddie. After that favorable jobs print, what stood out to you in the jobs report and your expectations for investor reaction today?
So I think the biggest thing coming in today was fears of, are we heading into a recession? We continue to hear people make this recession call, and we've been pounding the table on the fact that the labor market is too strong to be concerned with a recession. So look, the job number wasn't through the roof. I think we added 139,000 jobs today, but unemployment rate is still really low. And the thing that sticks out to me the most that's happened now 2 months in a row is wage growth increases. This is really, really good for the economy, because what's happening right now is wages are increasing at a really nice clip, while inflation's rate of change going up is slowing. So that's a net positive, because we know Americans like to spend money. So this extra money that these folks are making is going to pour back into the economy, and we just don't see a recession this year. We can certainly see things slow down, but if you think about it, a little bit of a slowdown is what the Fed wants and needs to justify rate cuts. So we think we're going to head into this Goldilocks type market where, it's not going to go straight up, but once we get past these trade deal concerns and they get done, and we look forward to what we're going to see heading into late summer with potential cuts coming down the road, new policy, trade behind us, we think this market is going to make new highs and have a really strong 2025.
Eddie, do you share the concerns of the bond vigilante crowd out there with the so-called one big beautiful bill, the budget reconciliation bill? I think on the one hand, I'd argue, yeah, you know what? Investors in the equities, they want to see the bill get done. We want to see an extension of the 2017 Trump tax cuts. But clearly, hey, we've seen treasuries give us some warning signs about increased concerns over debt and deficit. Where do you stand as we watch that bill be litigated in the Senate, knowing there's a big impact on the markets?
There is. So I think with this bill, the amount of debt increase is going to be good for equities. I don't agree with increasing debt at the rate we are, because there will be a big price to pay at some point in time over the next few years. But initially, you will see equities continue and risk assets to appreciate. But the Treasury market's going to be extremely challenged. We don't own any treasuries for clients. As a matter of fact, last year, because we got pretty bearish on what bonds are going to do, we actually took some of our bond exposure and we bought gold as a replacement for that defensive part of the portfolio. So we would not be buying treasuries, because I think ultimately the 10-year is going to go over 5%, probably sometime in the next 6 to 12 months, probably on the latter part of that. And that will cause some disruptions in the equity markets. But make no mistake about it. I mean, you're printing money. It's like putting extra stimulus into an economy that doesn't need it. And it's a drug that we've been addicted to. And it causes asset prices to inflate. But there will be an inflection point. And that inflection point will be when the Treasury market breaks down. And that means that we're blowing well through 5%, going to 6%, and maybe not getting a bid. And that's when you're going to have a real problem in the equity markets. But we don't see that as a risk here in the next 6 to 12 months.
Yeah, we certainly heard Elon Musk's chorus of concerns yesterday over the bill, over Doge, over many things. But you and I could do an hour-long special podcast on what happened yesterday. I do want to ask you about something you tweeted this week. You wrote, markets want to go higher, but I guess we'll need to hear what Powell and company have to say. Would be best to have them not speak. Why is no news good news from the Fed? And what would Powell have to say to give this market maybe a little bit of reassurance, Eddie? We could take another leg higher.
Well, that was the day that Powell was supposed to speak, I believe, at about 1 or 2 o'clock, and the market was down. And my point was, so many people have missed this rally. A lot of funds, a lot of hedge funds are short going into this V-shaped recovery that we bought into in April. And so this is why they're forced to buy. These funds are forced to buy, and this is why these dips have been pretty shallow. And on that day, Powell really didn't say much at all. And, when you don't say anything, it's better sometimes than what you say, because the market interprets it wrong. What the market wants to hear from the Fed is if they are going to cut rates. I think they'll only cut rates one time, and I don't look at that as a bearish thing. I think if the economy is strong enough to stand on its own 2 feet, we continue to grow, they don't have to be aggressive on rate cuts. And the market reversed and went back up really high that day. And you're seeing again more of that buying the dip after yesterday. Market tried to go down, But we did not have a bad day yesterday. Tesla had a bad day, but the rest of the market on a relative basis have been strong. You're seeing small caps catch a bid as well too, and it's because these folks are trapped. They have to get performance, and in order to get performance, you're going to have to buy this bull market. So it puts a floor on how deep the corrections will be, and we think we'll see just shallow dips here over the next few months.
I got 30 seconds. We did see Tesla down 14% yesterday. That stock is still down 40% off of its highs from December 18th. Let me ask you real quick, with the 30 seconds I got, you like semis, you like small caps, you mentioned there, you wrote about XLY. Discretionary names were hit hard. You see them bouncing back. How do you weigh discretionary versus staples right now, Eddie?
I would not own, we don't own staples in our tactical strategy. We are all risk on, and discretionary to us is going to break through the highs. These are the areas that got beat up the most during the crash that we had in the April time period. And we think 6 months from now, we're going to look back at yesterday as one of the best buying opportunities of the year in the discretionary names.
And discretionary so far on this Friday morning is up 1.3%. Eddie Ghabour, investors must be watching your interview. Thanks for being here, managing partner at Key Advisors Wealth Management. Always good to talk with you.